This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojasek from Trend Spider. We have a
breaking news. What is up, everybody? Happy Friday. Welcome back to another episode of Benzinga Live. I just realized literally like 1 second ago that it is Friday the 13th. So maybe that is why the market's not doing too hot today. We can talk about other reasons. The market started off a week this morning. Bank earnings, we're going to run through the big bank earnings that came out this morning. Of course, JP Morgan, among others. We also had Tesla trading lower, which, hey, look, bottom line, Tesla right now is still a major weighting of the S&P 500. So any day Tesla shows big weakness like it did this morning, you're going to see the SPY, or you could, the S&P 500, it's going to have an impact on it at the end of the day. So, we talked a lot about that, the volatility we've seen in Tesla's stock and how that's impacted the S&P 500 so far this year. We will continue that conversation today. Let me go ahead and get my Benzinga Pro pulled up, and we'll go and we'll run through the major indices today, just see where we stand as we get into kind of the lunchtime hour here. Again, Friday the 13th, man. I mean, very suspicious. I know what's going on there. All right. Start with the SPY. Down about 0.3% right now. Trading at that 395 level. We tried to get above that 400 level yesterday. Rejected. Could not get above that 400 level. Let's go to a daily chart real quick here and zoom out. You can see we've been on this upswing. Looking like we're trying to fill this gap up to 410. But ran into some resistance right here. I don't necessarily think like I'm not worried about the market here. I think the trend is your friend. I think we're still in an uptrend here, at least on a shorter time frame, and that a slight pullback, today it wouldn't be something that I'm that concerned about. Let's check out how Apple's doing, down about 0.2%. Tesla down 3.5%. Tesla news came out that Tesla is now cutting prices for their cars in US, Europe, and other. I mean, we saw the news last week that they announced cuts in China, and there were actually protests in China from people who had recently bought Teslas that paid, tens of thousands or $10,000, $15,000 more than people who bought the same car a week later. People said, hey, I should get a refund. Imagine if you bought something and then within a week, what you bought is worth like 75% of what it was when you bought it a week ago. And that already happens with cars. So you exacerbate that by the fact that, if a month ago you could have sold a used Tesla for the same price that a new one's going for now. Sorry, 1 second. He'll be... But yeah, and I do think Tesla's stock is going to continue to slide here because we're seeing not just sentiment issues with the stock itself, but with the cars. I think a lot of people are now starting to question little things about how, should this be happening on a $50,000 car? Should this part be peeling off? Should this part be... And so a lot of people, I think I've been seeing more and more of that on Twitter, on different social media. And the stock itself, look, as long as the Federal Reserve is still in its hawkish state, Tesla's going to have a hard time growing. And you've seen that. I mean, we're seeing demand problems now to the point where they're having to cut costs to try to get rid of inventory. And I made this point the other day on the show, and I know it's not really, it doesn't hold any weight. I don't think it holds any weight. I literally just thought it was interesting. When I was driving home from Chicago or back to Detroit from Chicago, I drove by a Tesla dealership, and it was in a very like wealthy suburb of Chicago, and it was just stock full. Like literally every single parking lot had a Tesla car in it ready to go, as if they couldn't get anyone to buy them, and not at all. So I think it will be a tough road ahead for Tesla. If you have a Tesla, I saw the other day on Twitter. Here, let me try to find it. There was a Tesla price of a car that had dropped. Oh, now that this news came out, it's going to be. There was a car, I think it was like the car dealership guy. Someone posted a specific used Tesla that the price on cars.com had dropped 15 grand over the span of the last like 60 days and still hadn't found a buyer. And I just think you don't see that happening. You don't see that happening, A, when interest rates are lower to where it's cheaper to borrow money and cheaper to finance a car. And you won't see it now, especially as people are more scared about a recession than they were a few months ago. Let's go back to Benzinga Pro. We should talk about Bed Bath & Beyond. So 2 weeks ago, Bed Bath & Beyond was trading at $2.30. Since then, in the past 2 weeks, Bed Bath & Beyond has confirmed that it's closing stores, confirmed layoffs, announced that bankruptcy filing is on the table, and now the stock is trading at $4.63. So it's up 100% from what it was, still over 100% from what it was just a few days ago, really. And since then, all this bad news has come out, and yet the stock is up more than 100%. These are the types of things when people who aren't, investing or following the stock market daily, you tell them something like that, and you're just like, they're just like, what? How does that make sense, right? If a company says bankruptcy is on the table, if a company announces that it's firing employees, if a company announces that it's closing stores, you would think the assumption would be that the stock would be down, right? Well, we're seeing the opposite right now. And it's not just, Bed Bath & Beyond. This isn't like oh, hold on. Jason Raznick is calling me. Hello? I'm live on the show.
Who are you playing the game with?
Who am I going to the game with? Jack and my friend who works for the Pelicans.
Is he going to be at the game?
Yes.
Do you have tickets yet or no?
Yeah, I do. Sorry, you're on speakerphone on the show, by the way.
Oh, hey guys. Peace. Bye.
Peace. Sorry, that was Raz calling about the basketball game tonight, Pistons game. Why? Sorry, let me catch up with the chat. Picked up 10 more what at the open today? Oh, Tesla not weak. Look at. Yeah, I mean, honestly, I actually agree, Daniel Rennie, that Tesla has been pretty strong the past week or so. Actually, now looking at the chart, doesn't look so strong now with the dip today, but was trading really well. I just think long term, this thing is going to continue its slide. I mean, at the end of the day, if you're running a company, you have a main product. Yes, no, I'm actually not. I'm not from Detroit. I live in Detroit though. We're based in Detroit. Benzinga is. Used car market was overpriced. Yeah, 100%. And it was a lot easier to finance a car. It wasn't just Teslas that have come down. But I mean, if you run a company and you have one core product, say Apple say Apple only made MacBooks, and Apple starts cutting the price for MacBooks, that is a textbook sign that the company is having underlying demand and inventory problems, and they're trying to match the demand with the new price. When the demand was up here, the price could be up here. But now that demand is here, they have to bring the price down. And when you're a growth stock, Tesla is a growth stock. That's been the whole story behind it. And now all of a sudden the numbers aren't growing or aren't growing as much as they were. You're going to lose a lot of investor faith. And then at the same time, Tesla still dominates the electric vehicle market share in the United States. I don't know what it is off the top of my head. I want to say something like 60% of like EVs sold last year in the United States were Teslas. Crazy. And I expect that number to continue to drop over time. Some of these electric vehicles from Mercedes, from Lexus, Audi coming out are really, really nice. I've talked about it with Jason on the show before. Jason Raznick, our CEO and founder. He's had a Tesla for 5+ years, got rid of it to get a new Mercedes EV and says he likes it more. Checking up on SPY, we are coming back up a little bit here. And although Tesla, I should say today, when that news came out, because we got the news, I was curious about this, how Tesla was like going to drop prices in China, but not anywhere else. It like didn't really make sense to me. Like that, like would there be an arbitrage opportunity to start buying Teslas in China and shipping them over here and selling them? I don't know, but maybe that was just always the plan to kind of cut them first in China, see the reaction, and then cut them in the US. But at one point, this thing was down like 7% this morning, down to, let's see, 115, and ripped all the way up to 121. So I do like, as a trader, I like seeing this volatility in Tesla, and I mentioned it on the show earlier, that as with Tesla being a bigger weighting in the S&P 500, that volatility that comes with Tesla is going to, bleed into the overall market. I think it's fun. I like seeing that in the markets. Talk about margins from auto. Yeah, I mean, historically, margins in the auto industry are very bad. I don't think, when I say that I expect the other legacy, car makers to kind of catch up with Tesla and EVs in the market share of electric vehicles, I'm not even necessarily saying I like the stocks. I mean, I've talked about that actually a lot on the show before, that historically, whether you're looking at like General Motors, let's go to a daily chart, you zoom out. Look at this thing from 2017 to 2020. In the meantime, we were making new highs on the S&P 500 every single day. You were basically better owning anything else other than, automakers. You could have been owning Apple or I mean, shoot, even Tesla in this time performed really well. So I'm not saying I like their stocks. I just think that Tesla is going to have a harder time maintaining its market share of electric vehicles in the United States and around the world. And we're already seeing that China, as more competitors pop up in China. Shares of several auto companies are trading lower on fears that Tesla's price cuts. Yeah, and part of the reason why I think Tesla's stock will continue to fall, I'd say about half of it is Tesla-specific problems, and one of those problems isn't really a problem with the company. It's almost a problem with how strong the company's been, just in the sense that I still think the stock is overvalued because people are want to own Tesla. At the end of the day, supply and demand will determine a stock's price, and there's a lot of demand for Tesla's stock compared to other legacy automakers. So that problem specifically, that I think the stock is just still, when looking at underlying fundamentals, still a little bit overvalued. That's obviously a Tesla-specific problem. The other problems that may cause Tesla stock to continue to drop aren't specific to Tesla itself, but, overall, and like you guys are mentioning in the chat, look, with higher interest rates, someone's car payments are higher. Someone's less likely to buy a new car. Demand has come crashing down since its height about a year and a half ago, when everyone, had stimulus checks and interest rates were at zero and you could finance a car for basically free money, and used car prices were insane. I remember looking to buy a, 5-year-old used Toyota Camry, and they were going for like $25,000. I was like, I would never buy a 2016 Camry for that much money. Couldn't even buy a used car, but that's changed now. Those prices have come down a lot. You see Teslas, like I said, now listed for, lower than $40,000, $30,000 on some sites. Let's just look real quick. I mean, we've got a computer, we've got internet. Cars.com. I'm in Detroit. Zip code, that's fine. What should we look up? Let's do a Tesla. Why not? All models. Ooh. It's still pricey. Holy shit. That's not a bad deal. Only 66,000 miles. 38,000, still 573 a month. A year and a half ago, that was probably closer to 500 a month. Let's see what the cheapest. How do I sort by lowest price? Damn, that's a 2014 though. I wouldn't buy that old of a Tesla. I don't know how long those batteries last. All right, 1 second, y'all. All right, sorry about that. Just got another call. Alrighty. What about, all right, so Tesla's still out of my price range. Let's go check out some Toyotas because I remember, oh my God. Golly. It's a snag and a half, $2,000. Oh, I think we're just sorting by lowest price, right? We're sorting by lowest. These are now the cheapest cars just in the 30-mile region. Sorry, we'll get back to stocks in a minute too. Chris Capre, by the way, is a freaking awesome options trader. Will be joining us in 10 minutes. He actually teaches some of our options courses here at Benzinga. So if you want to learn about options, we're going to talk about Tesla. We can talk about Tesla options with Chris as well as anything else you want. But for just a few minutes, let's see if we find any diamonds in the rough here. Oh, yeah. Sorry, the whole reason we started talking about other... Yeah, I do. I do think the Fed will reverse course, start cutting rates, but not... the more we see the labor market continue to be strong, the less the Fed really has to do that. I don't really see the Fed having to cut rates until later in the year, maybe even like summertime or so. And when that happens, yeah, growth in Tesla and all those stocks will start ripping again. But until that happens, I just see a really tough road for Tesla's stock, at least, to get a lot of people buying it to the point where it's coming up a lot. I do think, however, with how beaten down the stock has been, you could continue to see it just rally in the short term. But I'd bet more money than not that a month from now, Tesla's trading below $100. 2 months from now, Tesla's trading $100. Doesn't mean that it won't someday make new all-time highs, whatever. I'm just talking about in that time frame. But yeah, we were talking about the margins have been really shitty for legacy car makers. That's why the stocks, like I showed the GM chart. From 2017 to 2020, GM stock did nothing. And we were making new highs every single day. The economy was the best it had been basically ever. And yet somehow the stock wasn't going up. Because it's a hard industry. They're not that profitable companies. There's not a lot of growth there either. And that's why in 2008 and stuff, like the auto industry was one of the industries that literally had to get bailed out. Other industries were, able to withstand a little recession. Automakers, not a little recession. It was a serious big recession. The automakers, not so much. Tesla's margins are a lot better. And I've talked about on the show before, there's one aspect to how and why Tesla's margins are so great and how it's also kind of an Achilles heel. I'll explain it. So Tesla kind of revolutionized the way the actual models of the cars are made, where essentially it's not really, but it's almost like, imagine it's just like a mold and like one piece. So if you go to a Ford factory and they're, assembling, and he's assembling like all these different, parts, where Tesla is mainly just like one or two parts, it makes it a lot quicker, a lot cheaper, a lot easier to assemble those cars. That's how Tesla gets some good margins. Now, the bad part of that is if you change the molds or that system at all, you're ruining that system that you have for good margin. So it disincentivizes Tesla to build different models. That's why like the Model 3, like some of the Tesla models look the exact same as they have for 5 years. You see other car companies, I mean, even the American like Ford and stuff, they try to incrementally put little design changes. And I mean, year to year, like an Escape looks pretty similar, but if you look at one from 5 years ago versus today, you can see the difference. And in Teslas, they're very similar, because anytime Tesla wants to make a big change on its body, it will cut into those margins and not be, you'll have a lot more fixed costs with that. No part is the best part. Yep. How many iPhone models are there? Like out at any given time, or how many have there been? 14, 15? And it's the same thing with iPhones. I mean, think about it. They all have a factory set up to make this shape phone. If they switch the shape of the phone next year, you got to rebuild all of that. If you keep with the same phone shape and then upgrade other parts of it, it's going to be a lot cheaper. But Apple still upgrades the bodies all the time because they know that's what the customer wants. I mean, I don't even disagree with the business model. I think it's smart. Personally, I just think that there are customers that get, antsy, essentially saying like, we've had basically the same Tesla body type options for the same, few years. When are we going to see something else? Let's keep going through some cheapest cars in the Detroit area. Ooh, little cargo van. You could honestly, I don't know enough about the actual mechanics to be able to look at this to know if it like runs, but probably, or not, runs decently well for having 200,000 miles. But this is one of those vans that like you could spend a whole summer project like outfitting to be able to live in. That's what I would do with it. Holy shit, 346,000 miles. That's a lot of miles. Why would anyone pay for a $1,000 Apple iPhone? I don't know. I mean, I've never really been, I've always had an iPhone and not an Android. I've never really been that opposed to like trying to switch it up once in a while, but I don't think you can argue the fact that like iPhones are good phones, right? Like they're the most, they're probably the product that people use the most. Well, smartphones in general, but they're very, I don't know, they're just like easy to use. Lexus renew cycle is much lower because they have reliability. Ooh, Caddy. Buick LaCrosse. Oh man, Spy's rolling over here. So yeah, I mean, we've definitely seen used car demand come down a lot, but I still think this Tesla news cutting prices, I don't see the stock, but like bottom, like, I don't know. I would just be shocked if this thing isn't trading lower than it is today in a month from now. And I'd be happy to be wrong, because if I'm wrong, that probably means if Tesla's trading higher than it is today at 120 from a month from now, that probably means that the S&P 500 is also trading higher, and I'll probably be up money if that's the case. But with just the fundamental news from a chart perspective, however you want to look at it. I get it, guys. Trust me, because I have stocks that I hold, when they go down too. And as a long-term investor, it sucks, I think, when you're going through periods where, it might not be something that the company's fault, could be macro conditions, all that stuff. I think in this case, a lot of stuff from Tesla is self-inflicted. And it's tough, but as a long-term investor, you can basically say now's a good time to be adding positions if you have that conviction, which I personally, at this price, don't with Tesla, because I think it's going to keep going lower. I might as well try to get it at a lower price if I want it. Guess who's back? I see my man Chris Capre hanging out backstage. It's about a minute till noon, but let's go. Let's get right into it. Let's go ahead and give Chris our very special Zinger Nation welcome. When we come back, we'll be talking some options. We'll be talking whatever stocks Chris has been watching. If you've got any stocks you want us to check out, we've got my man Chris Capre on the show. Just drop them in the chat, and we'll take a look. Mr. Capre, how are you?
What's happening? How we doing?
I am good. How are you? Happy Friday.
Happy Friday. Good to see you. Good to be back.
Good to be back as well. Your long-awaited return to Benzinga Live. It's great to have you. I know the audience is excited as well. So we were talking about Tesla today. What are your thoughts?
Do you want the short, medium, or long-term outlook? Which one do you want?
I want, give me, is it trading, in your opinion? I know, you don't got a crystal ball. This is not investment advice. If you had to guess, higher or lower a month from now?
I would call that somewhat mixed. I think it's going to be dependent upon the FOMC and then the earnings that comes out. So it has earnings on the 23rd, which is after the OPEX. So next Friday is the monthly option expiry for it. What I see right now in terms of the option flows is I see about a third of the options on Tesla expiring today. And then there's about another third that are expiring for next week because it's the monthly OPEX. But of course, you're going to have a lot of traders that are going to be positioning options after the thing. So let me show you a screen, kind of what I'm looking at here. So as you can see, here we go. I think it's the 25th. Yeah, so this is after the monthly OPEX. So I think over the next 2 weeks, it's going to be dependent upon the flows. And for S&P 500, I don't see the S&P 500 really making massive ground from here. We had from the beginning of January, we've had about a 3.27% rally in SPY. So if we look at, what is it, January, this is January, the first session of trading in January. That's about 3.2%. So it's at a 3.2% rally, and traders sold a lot of calls yesterday at 400 and above. And that's not a bullish view from the options traders. They're saying, hey, we don't think it's going to break 400. That's why we're selling those calls. We want to collect that premium. So I think SPY has a cap not only this week, but probably next week. I don't see it closing above 400. That's going to make it hard for Tesla to have some fuel next week to ramp. Maybe there's some news that comes out, but I don't see Tesla over the next 2 weeks really making significant ground unless some sort of catalyst comes out. You were talking about the price cuts earlier today. If a company's doing good, you don't cut prices. Like my Benzinga option school is doing well. We're not cutting prices on the Benzinga option school. In fact, we're thinking about raising it as we add new features to it. So they've cut prices drastically in the last several times, which tells me that they have inventory piling up and demand is not meeting the inventory that they're creating. So it's definitely got some headwinds against it. And if the earnings comes out not that strong, then I think it's going to start to be dumped in mass. I don't think traders are going to buy that dip per se. And then at that point, I think the only thing that can save it a month out from now is the FOMC coming out dovish to where, traders start buying SPYs and lifting all boats, so to say. So I see challenging times ahead for Tesla. Short term, if I look at this kind of 1 hour chart, Tesla hasn't gone anywhere on the week. So this is where it started the week. It opened right around here, and here's where it is. That's not usual for Tesla to not do much on the week. It's literally been stuck between 123 and 115. I think if it starts to lose 115, I don't see option flow support to like 108, 105, 104. Like there's really good flow support in this area over the next week or two. Now, if it can get a daily close above 125, then I think that opens up the top side a little bit. But I have the feeling that they're doing all these things because they're trying to either buffer what they suspect is not a good earnings, or they're doing what they can to ramp up the stock price. But you shouldn't have to manipulate the stock price. Like if you have good earnings coming out, then you don't need to do anything. It's gonna come out strong, and that will communicate that to the market. So yeah, so that's kind of what I'm seeing over the next 2 to 4 weeks for Tesla right now. At challenging times, it's gonna need a lot of things to go in its favor to be up from where it is right now. And from a flow perspective, I see virtually no fuel beyond 140, 145. Like there's just no interest in Tesla, anybody being bullish, other than punters on the option flow side across all strikes and all expiries, especially for the next 6 weeks out. Nobody's thinking that Tesla is going to be above, 145 in a month or so from now, or 6 weeks out from now. There's just no fuel there. So it would just run out of steam.
And I mean, like you said, the fact of cutting prices is just not something you do when underlying demand is strong, or you do it when you got a big inventory you can't get rid. Like you said, I mean, you have your own product essentially. You know how that goes. I made the analogy. It's just like, imagine any company that's basically solely reliant on one product, like Tesla is with its cars. If you told me that company is now cutting prices of its like sole underlying product, I'd say I don't. And right now, I'm not saying I wouldn't ever want to own that company, or it can't be a great investment at some point down the road. But I would say, yeah, I wouldn't really want to own that company in that environment, and maybe wait down the road till when the Fed is in a position to where it can or is forced to be cutting rates and growth comes back in favor. Then it's time to maybe reconsider.
Yeah, and one thing we have to consider is that, Tesla, most of its growth as a stock, we're talking, 2019, late 2019, right? Now, we know that a lot of this, was COVID exuberance, right? A lot of option flows were massively overramping this. And then this here as well, this was like a bunch of options and all kinds of things. So 2020 post-COVID, once the market bounced, traders started making a lot of money, like a lot of money. And that increased speculative flows massively. And so, we think about that. And 2022 was like the 8 a.m. in the party when like the lights go on and people start to see like who's hungover and like who's not looking so good. Like that's what 2022 was. That exuberance from 2020-21 did not last, to the point where we've retraced. Now we are back at June 2020 prices. Like it's hard to think about that we are back to June, July, August 2020 prices. There's some speculation that it could retrace almost all of this. That's certainly a possibility for Tesla. One other thing I want to mention about Tesla is that, other than if you think about it, the stock really didn't grow that much. Like it had this period of growth, but look at what it did, over years and years and years. You're talking a 7-year period where it basically didn't do anything in the stock price. So if you're basing all of your ideas about Tesla simply based upon 2 to 3 years worth of price action that were over exuberant, over leveraged, kind of, everything was on full, like all systems go, you might have to temper those expectations. And the last thing I want to mention about Tesla is that Tesla as a company, very much like many of the tech companies, benefited from the very low interest rates that the Fed had. That means that they could borrow capital and finance their growth for cheap. Like they can literally borrow for 1%. So if you think about it, if you can, with your product, make a 10% return, then it is economically irresponsible to not finance your growth. Like you should be borrowing money at 1% to get a 10% return. You're going to get that 9% spread. So a lot of these tech companies experience an enormous amount of growth in that decade and then leading up to COVID. But now that the interest rates are much higher, what are we seeing? We're seeing tech layoffs across Twitter, across Amazon, across Salesforce, across Apple, all these tech companies. And I think Tesla could be vulnerable to that as well. So, it was easy to finance growth then. Now it's not so easy to finance that growth. And if you're cutting prices, Tesla used to have excellent margins, like 13%, 16%. They've just cut those margins down drastically. So if you cut your margins down and demand is waning, that's not good for profitability.
Well, yeah, I mean, think about if you say your margins, I'm just going to make up numbers, are 10%, and you do 1 million sales in a year, and the next year your margins go down to 5%. If your sales don't increase, you're not gonna match that revenue number that you hit the year prior. So,
Yeah,
and I don't think sales are going to increase. I don't even think with the price cut, I'd be surprised. I mean, maybe who knows? We'll see. But they'd have to sell a lot more cars at the new price point, essentially, to make the same money. And I don't think it would really come as a shock when Tesla's numbers, revenue year over year, whatever, is lower, because the stock price is obviously reflecting that. I mean, looking at it down, what is it down now? 60, 70% from its highs?
I mean, it's pretty brutal. I mean, I think Elon's now in the Guinness Book of World Records for the largest fortune ever lost in history. Yeah, 75%. It's down 75% from the highs. It's very rare that a stock will lose 75% of its value and then regain that within a year. That just like almost never happens. And we have to be honest that a mega cap stock in a period of 7 weeks growing 118% is not normal. We have to understand that a mega cap stock gaining 53% in a period of 4 weeks is not normal. So if people are basing their evaluations of Tesla based upon these 2 years, I think it's kind of you're looking too much at like the weightlifter on steroids with them, versus them without their steroids, so to say. So it's
right.
That's kind of what we're seeing right now. I think it's a little bit people are just kind of still used to the growth that it had in the last 3 years when that party's over.
That's a great analogy there. So let's transition, Chris, from Tesla maybe to just some more general overall market. I mean, looking at the S&P 500, do you think we're going to come down and retest these lows that we saw a few months ago in October?
I think we'd have to have a bearish FOMC for that to happen. I'm not seeing that on the flow side on the options. So as you know, with the Benzinga option school and everything, I look at the option flows every single day, look at total open interest changes, where positioning is, and I'm not seeing that right now. We're seeing VIX move, consistently lower. So let me pull up VIX real quick. And so VIX is finally breaking out of an elevated structure. VIX was in, so this is COVID. This base is way higher than pre-COVID, right? So that shows elevated risk concern. And then what happens? It stays elevated for a period of time, but now it can't make these new highs. I think VIX is probably going to be going down to 15 by the end of the year. So I look at this as like, okay, VIX is coming down. SPYs, I look at SPYs overall in terms of the flows. Yeah, traders sold calls at 400 yesterday when we got to 388, right around there. They're like, I don't think we're getting above this mountain here. But I don't see traders on the option side reaching for, long puts. I just don't see that. There's not a demand. So either they're discounting it or they just aren't worried. Keep in mind, we don't have anything now. This is like next week is going to be the first week where we don't have any major events coming up. We don't have FOMC till the 1st. So that's the week after. We have the OPEX. So I think what's happening right now is traders bought calls. You got to remember this thing has rallied since the beginning of January, 3.2%. So traders, at some point they started buying calls in this, right? So if you build up more calls than puts, then as we get to that January option expiry, what are traders going to do with those long calls? They're going to take profit or close them out, and that's it. So you pull some of that bullish fuel out of the market. And then dealers can start unwinding, their hedges associated with that. So you see a little bit of a pullback in SPYs. I wouldn't be worried about SPYs until you get a daily close below 380. If you get a daily close below 380, the flows then shift to negative gamma mode. Dealers then have to sell. If the market sells off, dealers sell. And so that's a little bit more concerning. Volatility would increase if we get that scenario. But we're not there yet. So only until we get below 380 do puts really start to kind of become dominant in the market. And so I'm not too worried about it right now. I think it probably consolidates in a range. I think it doesn't really close above 400. And then I think after the OPEX, traders will take some positioning and then wait until the FOMC comes out. So I think traders have a little bit of room now for the first time this year to be like, okay, I can take a trade for a week and not have to worry about any major events. So unless the FOMC comes out really hawkish and they're like, yeah, we're going to do at least 100 basis points over the next 2 to 3 sessions, like unless they do something, that's pretty hawkish, I don't see any reason why the S&P 500 should revisit the recent lows. Yeah, so I'm just not seeing that in the flows right now. Could it revisit 380? Possibly, but that would be probably extreme based upon the current positioning of the flows right now.
Yeah, and I mean, the way I see it, it's like a few months ago, or if you go back, say 6 months ago or so, when we were, feeling a lot more bearish, let's say, we were pricing in a lot of things, Chris, right? It seemed like the market was pricing in, let's say, a mild-ish recession, right? We had a lot of problems with, zero COVID policy in China, supply chain issues from the Russia-Ukraine war, people worried about an energy crisis in Europe, that, the UK is not going to have enough energy to make it through the winter and people are going to be freezing and all this stuff. And, a lot of those things I think have started to get a little bit better over the past few months. And like you said, like have the traders not having to worry about any big events or anything. The way I see it is that essentially right now it's like no news is good news. Like if things just are chugging along, it's like, oh wait, so we're not in this, big recession. So Europe's not having this energy crisis right now. China's coming out of the, COVID lockdowns and stuff. And as long as there's no big bearish events or a big bearish FOMC, swing, I think like standard is good right now. I think, run of the mill, no news is good news right now.
I'd have to agree. And I think what we're seeing is that we are seeing inflation cool a little bit. CPI came in at expectations instead of above. Inflation, it's still outpacing wages, but that gap or that spread is closing a little bit. So, gas prices have come down tremendously. You got to think about in terms of the average consumer, the most important things are energy, food, and housing. That's really the most important. And the Fed interest rates really don't have anything to do with that at all. Like very little impact upon that in terms of changing the course of inflation. But food is still expensive, but energy is coming down massively. We're seeing that at the pump for sure. And so I agree with you that no news right now is, I think, overall bullish. We have in the Benzinga option school and in the option surge, we have bullish positions on SPY already laid out through February for January and February OPEX. And we're going to keep holding them. We bought SPYs at 380. So just, that's literally like right here. At the end of the year, we bought SPYs at 380. So,
I've been kind of using this opportunity on any like weekdays or pullbacks, just been buying some calls because it seems like right now there's more underlying demand to own stocks than there are to sell stocks. And I don't really know, I get that with the Fed still being hawkish and, it's just so funny because like to me, like one of the most bearish arguments you could make right now, or one of the arguments I've heard essentially from bears is that with how strong the labor market has been, the Fed's going to be able to keep rates higher for longer. And it's like, but I hear that as, and this might just be an insight into how we all have our different biases, but as someone who is long and someone who's more bullish, I hear that as, so you're saying the underlying economy is really strong, right? The labor market's strong. Like, why do I think that's a sign that we're going to, come crashing down another 20%? I don't know. But, and on that point, historically, the market has tend to bottom before the Fed starts cutting rates. Not when the Fed starts cutting rates, but before the Fed starts cutting rates. So, I take all that into account as well.
Yeah, I think it's important to understand that, we haven't seen anything like this since like the 70s. A lot of people want to make comparison to, the Fed making pivots back in 2000s after the dot-com bubble and after the GFC and things like that. But we didn't have rampant inflation back then. This is obviously a different beast. The last time we had inflation like this was the 70s. Now, overall, I hear I agree with a lot of what you're saying here. And to be honest, in terms of the bias that you mentioned, it doesn't really matter if we have a bias or not, as long as we are willing to look at what are the flows communicating. Like we're willing to default to something that says, hey, in the face of the evidence, even though I have a bias bullish, the flows are bearish, so I'm going to short. Oh, in the face of my bias being bullish, the flows are bullish, so I'm going to buy. And I'm just not seeing from the option side, in the majority of these pullbacks, I'm not seeing traders reach for deep out of the money protection. Like if SPYs is at 395 right now, and you're worried about a pullback as an option trader, and you think SPYs is going to 380s, you're going to start buying puts that are out of the money that will make money if SPYs gets there. I'm not seeing that. Will
Yeah,
we
I
see
think we
some
would
of that
have to.
protection at the FOMC? Sure, but I'm not seeing that right now. The flows just don't communicate worry or panic or anything like that. They look pretty calm right now on my side.
And I would say, why would they, right? Because like I said, like when SPY was at, 355 or whatever, we got down to, there were a lot of bad things on the table, right? Inflation was, still a lot higher in the US and all those other headwinds I laid out. And a lot of those things, like I said, have started to get better. So it's not surprising that we, aren't seeing us panic selling back down there. People aren't buying those. And if we did, get back down to that 380 level we were at in October. Like I do think, we got down to 355 in October. Down to that 355 level in October, we would have to have like a fundamental bearish catalyst, whether it be FOMC, central bank, or, company wise, maybe some Apple announces some, big scary warning again. It's all these different, something essentially bad would have to happen. I feel like to get us back down there, Chris.
I think you need multiple things to happen I just think an FOMC on itself, even if they were to come out and say, hey, we have 3 to 4 rate hikes in the barrel, like most futures are pricing in about 2, and they're estimating between 75 and 100 basis points. So let's say we double that. Let's say they're like, nah, we got at least 4 in the barrel. Maybe we need to add more. Okay, SPY's going to drop for sure. But is it going to drop 40 points from here? Probably not. That is not just in terms of price. Not only is that an extreme move, 355. Yeah, it's like a 10% drop, but you're talking like a 5-6 standard deviation type move for that to happen over a period of even 2 weeks. That would be extreme. And it would need multiple catalysts on the flow side for that to happen. So I don't think an FOMC by itself is going to do that. There would have to be like some sort of deterioration in the Russia-Ukraine war to go with an FOMC, or like you said, maybe something with Apple or whatever. Like it would take a lot. It would take a lot for that to happen. And the flow side just isn't communicating that. And it's not just in SPYs. When I look at what's happening in a lot of these single tickers like Amazon and Apple and Google, those were stocks that had a lot of bearish interest. And the rises that we've seen in those tech tickers over the last few weeks has been a lot of that bearish bets unwinding. So it's starting to kind of like normalize again to like, hey, we're starting to get like we've unwound the extreme bearishness and now we're starting to get back to a little bit more normal levels. So I'm just not seeing traders in those tickers reach for deep out of the money protection. So option traders on my end, they don't see it right now. And I unless something new catalyst comes out next week, I would be happy to buy a decent dip in SPYs. I'm still bullish right now, and I'm going to keep holding my bullish positions, both for the January OPEX and for the February OPEX as well.
Yeah, Chris, I'm curious, what do you think about, when people say, or, I heard people say a lot of this when we were, in more of a downtrend, in more of a bearish market, I guess, but that we needed to see essentially that panic selling, needed to see a capitulation point before the market was able to bottom. Do you think that's true?
Historically, that's been pretty consistent. But we've had many crashes that didn't need that capitulation selling, so to say. We got to understand we have a lot of forces that came together in 2022 to create a bearish run. First off, the Russia-Ukraine thing probably caught a lot of traders off sides. That was a huge thing. And that had a huge impact on supply chain. Like there were countries that had nothing to do with that were heavily impacted by the supply chain. Yes, the supply chain isn't just Russia and Ukraine, but in terms of agriculture and commodities and things like that, it is. So, we had that. Then we had, still issues with COVID. We had inflation ramping up and then Fed, raising rates higher. That was a lot coming together. I, don't quite see the same scenario this year per se. I'm not saying I'm outright bullish, but I just don't see the same situation as, say, 2022. So I'd have to agree with you. Some of the overall sentiments you've been saying, I'd have to agree with them for sure.
Yeah, and I mean, I think, like you said, historically that's been the case. But when you look at, in terms of just like sample size, it's like, all right, we're looking at what, 3, 4 major bear markets in the last 30, 40 years, so it's, I think hard a lot of times when people, try to extrapolate certain takeaways from previous bear markets to now, because what the environment we're dealing with in 2023, right, coming out of a global pandemic, all of these things are really, you haven't seen a lot in terms of markets before. So I think, and especially the capitulation point, or the capitulation for selling, like that, that becomes, I think, or it becomes essentially less of a likelihood the more the Fed is able to navigate in a potential, if not a soft landing, a soft-ish landing. I don't think the Fed really thinks that's a possibility. You've heard Jerome Powell basically say we're looking for unemployment numbers to come up. We expect that to happen, to have inflation come down. But for whatever reason that doesn't happen, right? Inflation keeps coming down and unemployment stays where it is. It'd be hard to imagine that we're heading to that capitulation point, right?
Yeah, so a couple things I want to mention that they're really good points. First off, the Fed has never been able to engineer a soft landing in history. Never. It's never happened. They're like zero for however many soft landings they've tried to engineer. They've never had. So their record on that is absolutely abysmal. Be that as it may, in terms of the capitulation thing, we got to understand that traders, were a little bit slow in 2020 to get downside protection. But then they really bought up on that downside protection. Like for months and months in 2022, big funds and traders were buying long puts and buying downside protection. But what we noticed is that when the market started to bottom a little bit and that downside protection wasn't paying off, traders said, you know what? We're not as worried about that. And so because traders over leveraged on the downside protection, it might have helped to eliminate some capitulations. When you overbuy insurance, it generally protects you from those potential downsides, so you don't have that capitulation. We could have seen some capitulations in, say, FTX. That obviously hit a lot of funds. Maybe the capitulation happens in the crypto space. That's certainly a possibility. I don't think FTX is the only domino to fall. I think Binance is probably up next. So, they've already had problems with like withdrawals, and the CEO was kind of cagey about answering the questions very directly and concretely. So maybe the deleveraging, maybe that, capitulation happens in the crypto space and not in the stock space. Would it, do we have to have a capitulation? Historically, in probably 80-70% of the bear markets, there's generally been that. And that usually means that you get some huge spike in VIX. We had that huge spike in VIX come COVID, but anytime you have an enormous spike in VIX like that, the following subsequent spikes get smaller and smaller in both amplitude and frequency and depth, basically. So I haven't seen that follow-on capitulation yet. If we're going to get one of those capitulations, I think it happens this year. And I think it happens because it would be secondary effects from the inflation are now starting to bake into other areas of the economy. But if that doesn't happen, if we don't get that capitulation this year, then I don't think there is any more capitulation for the bear market that started in the beginning of 22.
Yeah, I mean, I pretty much agree, all with what you're saying, Chris. And I think, I like how you have an approach where you can look not only at the charts, but at the option flows and have all of that account into your sentiment, how you're viewing the markets. Real quick, do you have any takeaways from bank earnings this morning, or any other stock, or I'll ask that, and also just in general, if you have different charts or stocks that you've been watching the setups on, or particularly like to the short side right now, I'd love to talk about them.
For sure. So let's look at banks. So and then we'll look at the intraday charts on this. JPM has recovered all of its earnings loss and then some. It wasn't a huge reaction. Like it didn't move outside of the implied move via options. The options was pricing in probably close to like an $8 move or a $10 move, and it moved $6. So it's kind of like it didn't manifest as much as people thought. Obviously, this started to affect pre-market and SPYs, but it's recovered all this and then some. Citibank did pretty good. Like, they have done pretty good. They've held their own a little bit more stably. Wells Fargo is still, not quite there yet. I would consider Wells Fargo and Bank of America to be the weaker ones. I would consider JP Morgan and Morgan Stanley to be the stronger ones. So if you like finance, the fact that they recovered, I think those two would be the other ones. And if you don't want to have a U.S. bank, TD Ameritrade is a fantastic stock, in my opinion, to own. You get 4.12% dividend. Canadian banks are generally a lot more stable than U.S. banks because they have certain regulations or rules about what kind of risks they can take on, which is less. So they tend to be more stable as a whole. And if you think about it, their clients as a whole tend to be much more stable. Canadian protections and things like that limit the amount of risk that you can take on in certain things. So I like TD Ameritrade in terms of the financial sector. The fact that JPM recovered, I think that's a good sign. I prefer Citibank, JPM, Morgan Stanley on the American side, and TD on that. In terms of other tickers I'm looking at, TSM is looking interesting to me. So TSM has, let me just pull up the flow data on my end. TSM has about, maybe 20% of its options coming off the board next Friday. It's had a pretty good run, off this kind of lows here. This is, what is that? Roughly 17%. Other than this pullback, if this pullback didn't happen, I would probably still be staying bullish. But with this pullback, I think what we're seeing is a healthy profit taking and correction in TSM. I'm looking at TSM, and we were talking about this with the Benzinga Option School members today, between, say, 80 and 82.5. Like, to me, that looks like a really area to start getting longs for several weeks out. Do I want it at the current prices? No. But I like it, and I think the pullback we're seeing is very healthy. I think traders have a lot of long calls. As I said, about 20% of all the options are expiring on TSM next Friday. So if you've been long calls since, the beginning of the year, you're probably thinking, maybe I want to take some profit off the board. Maybe I don't want to eat 3 days worth of theta this weekend. Or maybe Monday, Tuesday, Wednesday, you're like, okay, I've done enough. I don't want to hold through the OPEX and take these large chunks of theta. Let me get out. So the market pulls back late next week, finds a base, and then resets for the following month. So I like TSM. And I'm liking the way Google and Amazon are starting to show some transitionary, price action here. So, for a while this is staying bearish, but now we're seeing higher lows and a new higher high and a new higher low. That's constructive. That's a type of transition in the flows. Prior to that point, prior to this new higher highs, we hadn't seen a higher high in a long time, almost a month. So we're now starting to see those transitions. And it's not just in Google. We see it in Amazon as well. So I'm starting to like Google and Amazon, at least for the next week. I'd like to buy pullbacks in either one of those, hold it towards the end of the week, or maybe buy it, wait till next week when all these options come off the board, let it pull back, and then buy it for several weeks out. So Google, Amazon look good on the tech side. TSM looks pretty solid as well. And then, of course, VIX. I think by the end of the year, VIX hits $15. So I think in terms of a long-term play, I think that's a really good long-term play.
Yeah, so with the lower, I guess like relatively lower VIX right now, do you think it's a better time to be buying options or selling options?
I like actually doing a mix right now. It just depends. If we get overextended on some of them, like let's take example SPYs. If SPY starts to get into like 400 today, then I think that's overextended. So a lot of people that are beginning traders will use the definitions overbought and oversold. And I'll be like, hey, what do you mean by overbought and oversold? And they'll be like, oh, the RSI is at this. And I'm like, that doesn't mean anything. From a flow perspective, I consider a stock overbought if it is the prices are above the majority of concentration of calls. So why would that be overbought? If the majority of concentration of calls builds up to, say, 395 in SPYs, and yet SPYs is at 400, and there's no option fuel for it to be at 400, then in my opinion, it's overbought. And the reverse would be for oversold. So to me, overbought and oversold is a flow-based decision, not an indicator-based decision. And in terms of selling options, I think SPY on a short-term basis is overbought if it gets to 400. So I'd be happy to sell call spreads above that. And we'll do that live in the Benzinga option school when that happens. But a lot of options, the majority of my options right now, out of all the positions I have, I think the majority of them are long option positions right now. Like I own the options. I didn't sell the options. I have one short option play on SPYs. I have 3 long option plays on SPYs for different expiries. I have a long option on XLU. I have a short option in Netflix. We sold puts at the beginning of this week on Netflix. We thought it was free money and that Netflix is going higher, and it did. So the majority, I would say 70% of my positions right now are long options and 30% are short. In terms of your question about the VIX, historically, the correlation is on a close-to-close basis about 78% of the time. If SPX is up, VIX is down, and if SPX is down, VIX is up. But there are periods in history for various reasons where that correlation doesn't quite hold. And it's not just like 30% of the time. Like maybe for this chunk of the year, maybe it'll be 40 or 50% that VIX can be up, SPYs up, VIX can be up, SPYs down kind of thing. Like that can happen. As long as the long-term average rebalances itself, that's fine. And I think this is going to be one of those years where you could see VIX up, SPY down kind of thing. So I don't think VIX being this low is one of those maybe we should be getting long options per se. I think this year will not be a good year for correlations in VIX, like those traditional plays to play itself out. I think we don't want to use VIX as the typical signal that we normally do.
Yeah. And I think with like people, a lot of people who are confused, I think, or not confused, maybe surprised that the VIX had not skyrocketed with how the market had been trading when we were in kind of a deeper bear market. But it was a lot different than, say, like the COVID bear market, where it wasn't, super quick. There just wasn't a lot of volatility. It felt like we were just going down a little bit every single day.
So most people do not understand VIX really that well. I see a lot of traders, like who was that group that got busted? The Atlas Trading Group. Like I saw a lot of those members like Ripster and all these people talking about like, oh, VIX does this, it's going to do this. And I'm like, bro, you do not understand how VIX works. So VIX is not you don't trade VIX technically per se. In terms of how VIX is priced, so it's a very simple way to look at it. VIX is correlated to the SPX, right? And the way it looks at all the out of the money puts and all the out of the money calls. And it looks between a 23 and 37 day window. It takes 2 expires, 2 Friday expiries in that. So the first Friday expiry that's 23 days or greater, and then the next Friday expiry that's less than 30 days or greater. This is a lesson from the Benzinga option school. And what it does, it takes all the options that fit those expiries, the out of the money calls and out of the money puts, takes the bid and the ask, and then finds the midpoint. And then it throws all that together, and that's how you get the VIX. Now, in terms of the big VIX spike last year, well, in the beginning, VIX was pretty elevated. It definitely was elevated above its average for sure, and it was holding that kind of elevated status. That's because traders are buying these out-of-the-money puts, right? You buy out-of-the-money puts, it stretches the skew, and therefore it expands the price of VIX. So in the beginning, that was happening. But as those out-of-the-money puts started to pay off less and less and less, traders said, you know what? Instead of buying out here, maybe I'm going to buy a little bit over here. And so then VIX starts to come down because the values of those out-of-the-money puts, that range becomes smaller. So VIX is not, that's how you price VIX. You can't trade VIX as a technical indicator because the pricing of VIX is based upon the out-of-the-money options and SPX. So in terms of, VIX not screaming like people thought it was, that's because traders had oversubscribed to those out-of-the-money puts, which paid off in the beginning, but they kept doing it month after month after month, and the returns started to get less and less and less. And being long volatility wasn't the play it was. So now we're seeing a lot more demand around the at-the-monies. And as long as there's demand at the monies, the range of out-of-the-money strikes that people are buying at decreases, and therefore VIX sells off. So that's how VIX works. So don't trade VIX as a pure technical thing, like, oh, it broke 22. Like I'd see Ripster be like, oh, it broke 22, it's going 25. Like, based on what? The options aren't showing that it's going to expand to that. So don't trade VIX as a technical indicator. Trade it as based upon the option flows. So yeah, I don't see that right now. As long as the majority of options are collating around the at the monies, you're not going to see VIX stretching itself out. You're going to see VIX continue to decline. And if prices continue to collate even closer, then VIX will go lower. Or positive gamma environments. If we start shifting into positive gamma environments, which, we're almost there right now, then we will see VIX continue to decline. So I see when I look at the number of scenarios for VIX to increase, that's a much smaller range than I see for VIX to decrease on the year.
Yeah, I agree with all of that, Chris. And I think, like I said, it's just a lot of people were kind of confused or asking me a lot, why is the VIX not going up when the market's, getting clobbered? And it's like, well, there's not a lot of, volatility or really fear. There's not any panic selling. It's just people kind of steady selling their, their stocks. Chris, real quick, a couple things. So I want to, we got a comment in the chat basically asking if you could go over kind of a gamma squeeze, short squeeze, whatever we saw happen. I mean, we saw happen with Bed Bath & Beyond and Carvana yesterday, just basically how that can kind of happen and how options plays a role in that. And then also, I've been noticing, I think over the past couple months, and granted, I'll be candid about this. I don't really have any statistics or anything to back this up. This is just something personally I feel like I've noticed. I feel like I've noticed more and more like pre-market, random biotech runners up 100, 200% on like any given day. I feel like I've seen more of that over the past few months than I did the few months before that. And I hadn't really seen a lot of that since like the crazy COVID markets. Could that be a sign of like more speculation returning to the markets, or why do you think I'm seeing more of those random stocks going up 200% on any given day?
For sure. You got to understand that the majority of people trading those are not going to be institutions. That's speculative retail that's doing that. Sure, you could have some professional retail doing it, but you got to understand that as your account grows, I bet your position size grows. And eventually you get to a point where liquidity becomes an issue. Like you don't want to trade something with like 30 cent, 50 cent, 70 cent wide option spreads. You're like, hey, why don't I get my 1 to 2 cents on SPYs where there's no issues of liquidity? So, it's important to understand that I've been noticing the same thing. And I was like, wow, that's not good. Like maybe it's a sign that there's some bullishness coming back in the market from the retail side. And I think that's justified to some degree. And maybe they're looking for their lottery tickets. Maybe they're down a lot and they're thinking, what can I do to get a big home run to get some of that back? I don't know as to why, but I generally don't want to see that. If I want to see a good bullish market, I don't want to see super small caps, illiquid stocks having all kinds of crazy 205% moves. That's not healthy to me. But if I had to speculate as the main reason why, I think traders have shifted a lot of their trading from stocks to options, and that can increase volatility in stock because an option is much more leveraged. So getting to your question as to the gamma squeeze, there are essentially two ways that you can make a gamma squeeze and a gamma squeeze only. So gamma squeeze occurs when you got to look at it as like professionals and like the pool of options that they do and how they are transacted versus the retail. Like if retail comes in, if you come in to say your broker E-Trade or Thinkorswim or something like that, and you're like, hey, give me 10 contracts or 20 contracts on such and such stock. If the broker already has a big pool of like 10,000 contracts on that, your 10 contracts is not going to move the risk needle. So if it's not going to change their P&L, they're not going to make an adjustment to their position and delta hedge that. If you were a professional trader and you came in and say, hey, I'm going to buy 10,000 calls on Tesla, the dealer is going to immediately delta hedge that. In fact, they might even delta hedge it before they even fill the position so they don't create these huge disruptions in price. So let's talk about a lot of these retail stocks, right? So you can get a gamma squeeze basically when there's two ways. You can either do it via long calls or you can do it via short puts. And let's just take a look at the trader, the dealer, and the delta hedge. This is the delta symbol, right? So if you're buying a call, the dealer is short the call, or whoever's on the other side is short the call. And if they have to delta hedge it, if you're short a call and the market goes up, that's your risk. So how do you delta hedge that? You buy shares. Same thing with the short put. If you are short the put, the dealer is long the put. Is the risk to the downside? No, they're long the put. That helps their option. The risk to them is the upside. If they're to the downside, if it goes to the upside. So if the market goes up and they're long puts, then their long puts start to degrade in value. So what do? They buy shares. Now, in terms of a gamma squeeze, what happens is in a gamma squeeze is if these build up to a critical mass, either the long puts or the short puts or the long calls, and all of a sudden the dealers filled like 10 orders here, 10 orders there, and then all of a sudden they're like, wait a minute, I'm short 5,000 contracts in the last 20 minutes, and they haven't been delta hedging that. They have to now, what do? They have to buy shares. And so this ramps the market up higher. The dealers are forced to trade with the market. Traders are buying calls, the market's going up. The dealers are like, I have to delta hedge that because my risk is to the market going up, so I have to keep buying it. So it's like an accelerative curve of buying. Same thing with the short puts. If you're short the puts, dealers are long the puts, the risk is to the upside. And so they have to start buying shares to do that. That is what creates a gamma squeeze. The other thing about it is that creates a gamma squeeze is that gamma is always highest when you have the option closest to expiry and at the money strikes. So, sorry, go ahead.
I was just going to ask, do you think that institutional players are even touching these names like the Carvanas, the Bed Bath & Beyonds? And if so, how are they? Or is it basically all or predominantly, basically all retail investors?
I think day trading has become institutionalized on the option side, especially with the advent of 5 day weeks expiries on SPYs. We now have 5 days a week. We have 0 DTE options. And so the market
has awesome, right?
It's good in one ways, and we don't quite know the implications of what that means.
It's one of those it's one of those be careful what you wish for situations, huh?
The market makers and the brokers are happy because the transactional numbers have gone through the roof, so they're making money on this. But it's also forced institutions to start day trading more. And when you day trade, then you're starting to weaponize gamma more. So again, gamma will always be highest, closest to expiry, and at the money strikes. So if you now have 5 days a week where you have 0 DTE options and the number of flows is continually increasing on the day trades, well, then gamma is a much bigger value. So going to let's go to an option chain here and let's look at, say, SPYs. So if you look at the January 13th, look how high the gamma is here for the at the money. You can see right here, gamma is quite high. So let's say you buy this option right here for 40 delta. Look at your gamma, 21 cents. That means that if it moves $1 in your favor, your delta is going to increase by 21 cents, 50%. That's huge. If we take the same 396 or 397 strike and just go 1 week out for the 20th, look at your gamma. It's 5 cents. Your 48 delta only goes up 5 cents. It's like a ninth. So we're talking an 11% gain versus a 50% gain. So gamma becomes weaponized when day trading increases. And that creates huge changes in the delta flows and the delta hedging. So volatility increases on a day trading basis. I have no doubt the flows, the numbers are super clear. More and more institutions are day trading now. And so we've shifted to a combination of either we're day trading or we're holding things 1 month out. Because anything in between that, the flows don't seem to work out too well unless there's like, oh, we want to make a trade for 2 weeks for an OPEX or something like that. So the market has changed in such a way that it has to be more day trading. Getting back to your question, do I think these institutions are trading the Carvanas? Not the big ones. You might get some prop firms where you have some of your prop traders who are maybe trading a 500,000 or $1 million or 2 million book that can make trades like that. But you're not going to get a fund, that like one of their traders has a book of like 300 million and he's going to start loading up on Carvana because it would just be too much. So yeah, that's not happening. So the smaller professional retail class, sure, they could be, but not institutions. And so, yeah, it's just important to understand that 5 days a week in SPYs has changed the market. On average, we're seeing now anywhere from like 30 to 50% of all the flows on any given day are 0 DTE. That's a huge shift from, say, 1 to 2 years ago.
Yeah, and I mean your point about the daily option expiries, like traders may have for a long time, myself included, been like, oh, how great would it be to be able to buy SPY options, that expire on a Thursday or on a Tuesday, or QQQ
Sure.
options, and then you're given that capability, and we're rejoicing, saying, woo, now we can trade any day of the week options that expire that day, and traders are happy, but at the end of the day, who's making the money from that? Not the traders, the market makers, for the most part. So they're the ones that are really, at the end of the day, the ones that should be happy about that, which is, I guess just how the market works, right? It's kind of like, it's not a casino, but you could make the analogy, right, that the market is the house, and it over time wins.
It's the further financialization of the market. And, you're seeing that in a lot of different ways. Like, for example, I hear that credit cards are now saying, hey, if you buy something over $100, which, should be nothing for most people, but like, if you buy something over $100, you can make payments on that for no interest, And I'm like, wait a minute, you're already financing that through the credit card purchase. And now you're trying to financialize it a little bit further. So as financialization goes further and further down its kind of tree of development, it has to continue looking for new ways to find growth. It has to continue looking for new ways to find income. And in terms of trading, that means more and more expires. At the beginning of the year, in the first quarter of 22, in the Benzinga Option School, we predicted two things. We said, probably by the end of this year, you're going to see SPYs, 50DT options. After that happens, they're going to do it with Qs. And they did it, within that year. So they did SPYs and Qs. I wouldn't be surprised if in the future, because the market makers and brokers are going to be making a lot of transactional revenue from this, I wouldn't be surprised if you start to see single tickers start to move towards maybe 3 zero DTEs, and then maybe to 5 zero DTEs. Like, they aren't going to stop this train. And so do you think they're just going to be like, oh, SPYs and Qs, okay, we're done. Nah, we don't need any more zero DT options. We're good. Like, we don't need to make any more money. Not going to happen. Said no capitalist ever. So it's important to understand that, they have to keep looking for ways to find growth and income, and you just keep financializing. Like, the idea of 30 years ago of there being an E-mini or a micro mini was like out of this world. Like, never, if you had asked somebody 30 years ago in the 90s, like, hey, can you ever think of a scenario where they start doing micro minis? They'd be like, no. And in the FX world, if you ever asked them, just say, hey, could you ever imagine there being a micro lot, which is 1,000 currency, of the currency position notional? They'd be like, no. At standard was like a standard lot was 100K. So, it's this will continue. What we're seeing now is not surprising. I don't think we've seen the full ramifications of this. I do think VIX has been one of the victims of it, because if you have more and more traders trading zero DTE, then they have to be weaponizing gamma. You can't weaponize gamma through deep out of the money options that are expiring that day. You have to be closer to at the money. So if traders are doing less and less out of the monies, then VIX is potentially a victim of that, because they don't push onto the wings. Therefore, VIX doesn't expand that much. So I think there are going to be further knock-on effects of this zero DT stuff. I just don't think we've been able to fully see them yet. I mean, we know intraday volatility has increased for sure. Since the advent of zero DT 5 days a week, intraday swings are definitely increasing, because the gamma, again, can move that delta really fast, but we haven't seen it yet.
You mentioned, Chris, that I think at least that you said you were long option SPY into February, and I kind of wanted to talk about, like, how would I position? Say I was just like say I thought SPY was going to hit 430 by April, like essentially, even if I wanted to go and buy leaps, I would know how to go about it in terms of buying them. I wouldn't know how to go about it in terms of selecting like which leap I think would give me the best chance of return, or what I'm going for necessarily.
You wouldn't just want to think of one type of option strategy, like long calls or something like that. You got to remember that option strategies are just different ways to protect or grab alpha out of the market, right? And each option strategy by itself has ways that it can make you money and ways that it can lose you money. No option strategy has an edge by itself. Every single option strategy by itself has no edge. How you structure it is what determines the edge. And your ability to use different option structures to capitalize on that is what gives you the flexibility in options that you don't have in shares. If you think it's going to go up in shares, you have to buy shares. You can't sell shares, and you can't just sit on the sidelines, so you have to buy shares. But options, you have a lot of different ways to do that. So, let's just go through your experiment. Let's say you think by June, we're going to be at 430. Okay, well, you're in this tricky window where you're looking, say, 6 months out. And you wouldn't want to just buy outright calls, because anytime you buy a leap, your primary driver of the gains is not going to be the deltas or gammas, because you're going further out in time. So delta and gamma curves are flat. So your biggest curve is going to be in your implied volatility. You'd want to look for a situation where implied volatility is going up. But that's a problem right now, because implied volatility is lower than realized volatility right now. So it's really low. So implied volatility, yeah, it could go up, but unless it's going to ramp up massively, you're not going to make a whole lot on that. You're going to have very slow delta gamma acceleration curve. So then you have to start thinking about, okay, how can I offset the volatility, and time aspects of it, the theta decay of that? You could do bull call spreads. You could do broken wing butterflies. You can look for areas where there are kinks in the curve. So let's go to a SPY chart for a second here.
Let's do it.
Let's say, I'm looking further out. Let's say I notice.
I want to see SPY hit 400, by the way, today, by the way. I'm just trying to manifest that into existence. Doesn't need to cross 400. I just want it to hit it.
If it does, I'm going to sell call spreads. I'd love it to hit even 399. I'd be happy with that selling call spread.
I'll take 399 right now.
I'd be cool with that, because then I can sell some. So I have a bullet. So yeah. So anyways, let's just say you're looking at the implied volatility curve, and it's kind of normal, but then all of a sudden you see a kink in a part of the curve where there's one strike where it's particularly high. Well, then that might be a good place to sell some calls, but you don't want to sell calls already because you're bullish. So that's where a broken wing butterfly would be good, because you're selling one call, and then what you're going to do is you're going to short 2 calls at an area where you think that the implied volatility is not only above average, higher than it should be, but a resistance level you don't think it will get to. And then what do? You buy one call after that. This is done in a ratio 1-to-1. You can do 10, 20, 10 kind of thing. So you'd want to take advantage of that kink in the curve to where you're like, okay, this is overpriced than, say, the options just before that. So I'm going to take it, and I don't think it's going to get above here, so I'm going to do that. So broken wing butterflies can be a good option for that as well. You could also, if you wanted to, start doing calendar spreads, but then you have to time the changes in implied volatility, and that's tough to do over a 3-6 month period. So, in terms of various structures, when it comes to just outright bullish bets, I tend to look at bull call spreads and broken wing butterflies as the better plays out there. You could do diagonals if you wanted to, depending upon what the term structure looks like and the timing of it. It requires more timing. Bull call spreads and broken wing butterflies don't require a whole lot of timing. You just have to get there before your thing expires. Whereas in diagonals and calendar spreads, you have to have the timing of 2 separate strikes and the volatility of them right. Otherwise, you kind of miss out on ways.
Right.
So I would look to smooth that out. But I would also wait until, if you really are bullish, I think you got to wait until FOMC. I don't know if you want to get outright bullish until after that's cleared. Once they give that kind of rate guidance going forward, traders will look at that and be like, okay, I have a rough idea of where this is going. Okay, it's okay for me to pile on some bullish bets. Or, they might still have a few more, rate hikes in the barrel. Maybe I wait until they're done with that, and then I start leveraging that out. Because then, if the market doesn't go up, then the value of those calls will have decreased, and you have waited, and then you can get those same calls for cheaper.
Yeah, I mean, I think, I like that idea of putting that spread out there, especially like you said, if SPY gets up there. It looked like for a second, Chris, we were heading to maybe try to even turn green on the day, but looks like we kind of got rejected close up to around 396.70. So we'll see if we're able to get quite up there. But Yeah, I mean, a lot of volatility to start the year so far. It's been a fun market to trade in. I'm sure as an options trader, Chris, it's been exciting as well. But we are running out of time. Unfortunately, it's almost 1 p.m. But I did want to make sure you have at least a second to talk about the Benzinga Option School, and I'll go ahead and share a link to that in the chat.
And Option Surge. So the Benzinga Option School, we've ramped it up now. So I'm teaching live 5 days a week at market open. And so we go over trade ideas, your trade ideas, my trade ideas. Like what we're talking about today is like a small version of the amplified discussion we talked about in the Benzinga Option School. So you get access to all the lessons, trade ideas, feedback from me. We also are beta testing some of our option trading apps. So we have, like, for example, we have an app that's going to start displaying certain types of open interest graphically, and then across multiple tickers, across time. We are building a suite of products that are going to be for Option School members only. But then on top of it, I give trade ideas in the Benzinga Option School, and we created a service separate from that, which is the Option Surge products. So we have starter, enhanced, and ultimate tiers. Starter is I give 2 single legs a month. I already produced one last month. We bought the 380 calls on SPYs on December 30th. So I'd like you to just think about what those calls would be worth today. You can kind of do the math, but yeah, like December 30th on this day, we bought the 380 calls. SPYs is at 396 right now. So just start to think about that. So we have a service that you can take advantage of just my pure option signals alone. And it's super low cost, super easy. You get a little commentary with all the trades, stop loss, what we're looking for, that kind of stuff. So yeah, if you learn something from today's class and you felt like, hey, I want to see the markets differently and I want to understand options on a deep level, not just like a surface level, that's what the Benzinga Option School is. You can be with me live 5 days a week where we really go into a lot of what we explained. Like the VIX thing, that was just like one small lesson from the Benzinga Option School.
Yeah, and guys, go check that out if you have not already. Chris, it's been a pleasure having you back on Benzinga Live. It's been too long. Hopefully we can get you on again sooner. We don't go as long, in between having you on as we did last time.
Let's definitely do it again more often, for sure.
All right, Chris, well, enjoy the rest of your Friday. Have a great weekend. Everybody out there, smash the like for Chris and go check out Benzinga Option School. See you, Chris.
Take care.
All righty, y'all. Mr. Chris Capre, like I said, smash the like for him. All right, it's 1:01 p.m. That means it's time to head on over to Stock Market Movers. But before I do, I have a very important message. Today's show is brought to you by Cboe. Cboe operates in 26 markets globally and offers trading in options, futures, Forex, digital assets, and more for retail investors. Learn more about the power of Cboe markets and what they can offer you as a trader at Cboe.com today. That is CBOE.com. I'll drop that link in the chat, CBOE.com. We also have these cool supplements from, this isn't really honestly necessarily even an ad read. We're just we're doing some work with this company, and they were nice enough to send us these supplements. And I've been trying them out. They've got all different kinds, different types of athletic greens, night shred, fat burners. It's from Inno Supps. So I'll drop that link in the chat as well. Inno Supplements. Very cool company. And again, you can see if we get a zoom in on this camera, these greens juice. Wasn't feeling too great this morning. Chugged this before the show, feeling a lot better now. So again, that wasn't an ad read. This company, we are doing some work with them. They were just nice enough to send us these supplements, and pretty good. Inno Supps. I'll drop that link in the chat as well. So thank you guys to everyone who tuned into the show this week. We will be back next Tuesday. Next Monday, of course, we are not going to be live. The market's going to be closed in observance of Martin Luther King Jr. Day. So everybody have a great weekend. We will be, again, back on Tuesday. Peace and love. Stay green. Until then.
This